priority. We don't see.
They ignore me all lives.
But actually, the bathroom is brought across the street from Metro.
All of my April. Yeah, it's like.
I believe they're about. Because I think people want to fund things always. It's like.
Yeah, but not anything. So, you know, I learned to do,
But I actually did that this weekend. Yeah. Wait, it's the master's girl? Well, maybe does it. She's gonna get my baby. She made jumps at her too. You're off. Yes.
Yeah, usually I eat lunch or I mean,
The dude came in on my show. The whole point is that you're on this, well, yes, you're subsidizing it, but yeah. She sounds like a point. Yeah. She's like, should I take the levy? But yeah, that's why I mean. She goes, because they can go by that one, you're not actually. So they go. So we're looking for the garage. That's not even because like we don't. They turn on, like you pick your name, we don't run the first one. It's about intrinsic values of. I see it 15. Oh, yes. You'll think about it. If you really should just look at this one. Don't worry about offer. Is this today? Yes. How's I'll have everybody. Yeah, all of them now. I got about something. You know what goes fast. Yeah, I think it's very simple. I just can't remember water. Like, which some, and it's good because it gets you. Sometimes. Like I reached like.
Before I had.
Time that I'm never gonna get back.
I should actually. But yeah, he's.
That's so sad.
Go to that song. I just look at. I do, but like. Oh. Like I have. I like putting other stuff to. Yeah, I really. I have one.
Okay. I'm gonna do That is good. Here, yeah, what's your last name? But. But I talk her.
Oh, shopping. Like 10 pounds under. What do you like this? Yeah, it's a bunch of finding side of us. I think machine choke the rest that he's about the last.
Oh, no.
Yours then. It seems like it's like, yeah.
Yeah, it makes sense.
Yeah. Why is that right? There's no place on. I'm yeah, so Steve's.
So where's my looking at team? No, I'll take it and then. I'll take it. You're on the trace of it. Oh my God, what? I don't know. Was he actually take photos? And like one job too.
Oh.
No, it's in here. He gives me sauce. It's like Thomas. My heart. What if I didn't want to? No, because like I speak. Try harder. What are you trying to do? It's good. Yeah, he did. Oh, yeah. I know. Fingerprint.
Yes, it is one. So let's go. Let's finish this. Okay. Your contracts are due tonight. So, you know, I was just talking to someone about group members who don't even respond. If you've had trouble with your group mates, like we'll give them till tomorrow, like it's due tonight. We'll give them till tomorrow. But if you're having trouble with your group mate, especially prioritizing people who are the only one in their group doing anything, then there's still time for me to move people around. Like, because if we already have bad signals from some people, let's put all the bad signals together and let them figure it out. You know, I mean, that's what I try to do. Good signals, I'd rather have them together, because if you have good signals working together, they actually work together and learn something, which is the point of the group project. So if you're, you know, let me know if you're having bad signals. Because if you, like tomorrow, and if you are tomorrow, I'll just shift people. I'll just shift them. And maybe there's some good signals get shifted out of your group, but you know, the signal wasn't good early. Not a good sign when the signal isn't good early. Doesn't often get better later, sometimes, but usually not good. Okay. That's it, right? There's nothing else. This is the last stuff that we're doing that'll be on the first midterm, which is a week Tuesday. Yes, Nathan.
The review class on Friday is next Friday, right? Not tomorrow.
Right, not tomorrow, because people don't study this far ahead, so
I was gonna, yeah.
yeah.
Yep.
Next Friday, I set it up. It's on the list of Zoom calls. You should be able to see it. Anything else before we go with Radford? Okay. So I mentioned on Tuesday that sometimes I do exam questions like this, and sometimes I focus on the journal entries. More often the journal entries, because it's such a nightmare to mark this, but I don't know what I did back in January. So Radford, this is one where they're asking for the shareholders equity section in good form. So I'm going to show you how I would do that without doing journal entries, without doing every journal entry. As you can see, there's a few journal entries that I want to do because they're just not as simple. So like, I want to see it in journal entry so I don't forget things. And so like, I can hold it in my head, but some things I don't need a journal entry to do it. So let's go through. I find on midterms, when I do it like this as a big blob of text, not good. But if I did, I mean, I think chances are very high that I will have put these out in little bullets, because people do better when they see bullets. But you should, in your own mind, I need to like tag what I've done, like have a system so you know what you've dealt with, right? That would be a smart thing to do. So let's just tag these things as we do them. So Radford Corporation's charter authorized 1 million common and 300,000 6% cumulative non-participating pref. Okay, so the first thing is authorize. So I would set up frames for my common and pref shares. Just little tables where I'm tracking things. Number authorized, 1 million. Well, let me write it out. 1 million common and 300,000 pref. I know I'm going to prepare a shareholders equity section, so this bit of information is like a half mark waiting to be copied, right? Just copy it over beside my pref shares and I bought myself half a mark. Okay, so I got that done. I got that done. The corporation made the following transactions through December 31st. 300,000 common shares were issued for 3.6 million. Okay, now for that one, I don't need to do the journal entry. It's just debit cash, credit, common shares. I'm just going to put it in my frame and then it's done. Okay, issue. So that goes in my outstanding column. Plus 300,000 and the amount 3.6 million. All right. Oh, and 10,000 pref shares were issued for machinery valued at $14.75. I mean, again, it's not a journal entry I need to write down because it's debit machinery, credit pref shares. So I can just put it in my frame and that's all I need. So issue. Plus 10,000. And it's 1,475,000. Okay, so that's done. Okay, subscriptions. We haven't talked about subscriptions yet. Sometimes companies issue shares on a subscription basis. That means, just like, you subscribe to a podcast, you subscribe to the shares. So basically they give you time to pay for the shares that they're issuing for you. So let's read about this subscription deal. Subscriptions for 10,500 common shares have been taken, and 30% of the subscription price of $16 per share has been collected. Okay, so the people agreed to pay $16 a share, but they haven't paid that yet. They've just put a 30% down payment down. Now, it's important to read on and see what happens with the shares. The shares will be issued upon collection of the subscription price in full. Okay, so that means no shares have been issued. They're just subscribed and people have started putting money down. Some subscription deals work where they issue as you pay, but that's not what this deal is. So there's going to be no impact on my common shares account. And I'm going to do a journal entry. because it's just easier for me to track in my head if I've done a journal entry. So I did receive cash. Let me just see. Okay, hopefully people can hear me better now. Forgot to turn on the mic. Okay, no one's complaining, that's good. Okay. Cash. 10,500 shares times $16 per share was the subscription price times 30%. It works out to, 1 second. What does it work out to? Sure. Hold on a second. I have to go back a page here. Works out to 50,400. Now my credit is not to common shares, but it is to a related account, common shares subscribed. So like in my mind, I see it as a, you know, a grayed out version of common shares. They're not fully black on the white background. They're gray. They're like coming, but they're not shares yet. Common shares subscribed is 10,000 common shares times $16 per share, which is, it's 10,500, which is 168. I feel like my pen might be running out, which would not be good. And then I need a debit, and that's for the amount that hasn't been paid yet. And we're going to call that subscriptions receivable. For the difference, which is 117,600. Pen somewhere in here. Okay. A backup, so that's good. All right. So I've dealt with all the stuff related to the subscriptions. In addition, 10,000 common shares have been repurchased and retired. Okay, that does affect my common shares. So I have a repurchase. So I'm going to remove the 10,000. And I need to remove it at book value, right? Not at the price I paid, at the price they're sitting in my books at. That's the thing you have to remember for a buyback. It has to be the debit to common shares has to be at carrying value or book value. So then we need to know what the per share value is. It's just 3.6 million over 300,000. It was $12 per share. So that means when I do the repurchase, I'm going to take them out of that account at $12 a share. So that's 120,000. Debit to common shares. Then I know I paid cash at 15. That's 150. I'm not balancing. I need a debit. It's like a loss, right? I originally issued the shares for $12. So I issued the shares to Nathan. He gave me $12, and then I don't want to pay him dividends anymore. I don't want him to have any influence on my company anymore. So now I'm going to buy him back, but I have to give him $15 to get rid of him. So was that a gain or a loss to me? It's a loss, right? Because I have to pay more. What's the loss account in shareholders' equity? Because we're never going to put it through gain or loss, right? We'd never touch the income statement, Nathan.
Retainer.
It is retained earnings. Yep. Going to hit retained earnings. Now, if I had a prior air quotes gain and I had some contributed surplus sitting around related to common shares, then I would first absorb that. And if once that's fully absorbed, any excess goes through retained earnings. But I mean, we've accounted for this company since the start, and there's been no contributed surplus generated. So that comes directly out of retained earnings. Oh, and retired. So these 10,000 shares were also retired. They come out of authorized as well. All right. The retained earnings balance is 180 before considering the transactions above. So we'll need that when we do our statement of financial position over here. So we're ready. That's for the retained earnings account. So we're not going to track it here. Now we're going to prepare the shareholders' equity section. So first, sum all of these up. 990, 290, 3,480,000. And then this is just straight across. That's a plus. Okay, I'm ready. Ready to construct it. You're going to give me a good title, of course. What are you going to put as the caption for the first line? What's the first thing that we put in the shareholders' equity account by convention, Mitchell? Pardon me? Up here, yeah, but I'm talking here. What's the first? It is. Anything else you want to add, Mitchell, other than pref shares? Anything you want to put in brackets? Yes, so we're going to say 300,000 authorized, 10,000 issued and outstanding, because like we want to wipe up all the half marks. And then we're going to put that description in. So 300,000 authorized, 10,000 issued and outstanding, 6% cumulative non-participating. Half, half, half. 1 mark for the value, which was 1475. Everybody good? This is not too bad. Next account is? What is the next account? Chris, what would you put after pref shares? What other kind of shares are there, Chris? We've done preferred, so what's the other kind? Common shares, that would be the next thing. And then we do the same thing. We just go back to our table. 990 authorized, 290 issued and outstanding to just wipe up all the half marks. And then, of course, we need the amount, which was 3.48 million. So 1 mark there, half mark, and a half mark. And there's 1 for your good title. The other thing that goes in here, if you look at our journal entries, there's something related to share capital, which we set up, and it's common shares subscribed. We're going to put that in. with the rest of our share capital. They're like a faded out version, but it belongs with share capital, right? Common shares subscribed. The full 168. That gives us a total share capital of 5,123,000. Half for that sum. And then to get to paid in capital, right? They didn't pay for the full 168, right? So that is total share capital, but it's not the paid in capital. We're going to have to deduct the amount they haven't paid, which is the subscriptions receivable. That's going to get us to total paid in. Total paid in 5,005,400. Then we get to earned capital. What is our earned capital account? What's the name of our earned capital account? Lily. Retained earnings, right? Earned capital, retained earnings. Now, they told me something back here. The retained earnings balance is 180 before considering these transactions. So I'm going to put the 180. And did I touch retained earnings? I did, with my loss on the buyback. So I need to debit by 30. Leaving me with 150. And my grand total then is 5,155,400. The length of that question, I think that should be doable in an exam question. Like that should take you 20 to 25 minutes. I think that can be done. That's a good length. If I give you a question like this, I will probably give you a, like a part B or a part C, something related to what I'm talking about here. The share subscriptions receivable doesn't have to go necessarily in the equity section. So if I didn't have this here, if it's not in equity, where would I put it? In assets or liabilities, Nathan? Well, yeah, assets, because it's a receivable. We do expect to receive money. So the alternative presentation is like a contra equity here, right? So we could instead put it in assets. Okay, now let's think logically. Oh, is that better? If you were a CFO and you had the choice, because shockingly, IFRS is silent on this issue. IFRS isn't silent about much, but they are silent on this, which means you're not forced to put it here and you're not forced to put it in assets. You could put it in either place. So as a CFO, where would you put it? Okay, think about it this way. What would change if it wasn't here? What's going to change if we don't have this? What would change? It's gone. Yes? Okay, is that a good thing or a bad thing? It's definitely a good thing. So as a CFO, you're always worried about what your leverage looks like, right? So you don't want to have your equity lower because then your debt to equity is higher. So if you have the choice, you don't want to have negative numbers in your equity section. So yeah, preferred is the alternative, the asset presentation. Preferred, since equity is higher, therefore debt to equity is lower, and we always want lower leverage. You're not trying to report high leverage. I'm sure there could be some circumstance, but generally speaking, we're not trying to report high leverage. Okay, so I do expect you to know IFRS and ASPE. IFRS silent. Shocking. ASPE. They actually encourage asset presentation. They actually encourage it. They say, like, really, you should put it in assets unless you think there's a likelihood that it won't be collected, And if you're not sure it's going to be collected, then leave it in equity. But if you're pretty darn sure you will collect it, then it should go in assets. The other major set of accounting standards, which is, what's the other one that we never talk about? One other major set of accounting standards in the world. Well, I guess in the world there's two. And then in Canada, we also have our private company GAAP, right? What's the other major set of standards? What country might it be associated with, Mitchell? Yeah, US GAAP. Yeah. We don't need to know that in the Canadian context, but under US GAAP, now that's a GAAP that's like not silent about much. Extremely rules-based, extremely voluminous set of standards. It's embedded in their legal system. Like, there's a lot of standards. They do talk about it, and they actually require equity treatment. So what we're looking at here is definitely what you would have to do if you were reporting under US GAAP. If you're a company that wants to be comparable to your US competitors, maybe you would do this. I think you probably wouldn't. But you know what? Remember I told you those guys, those Bay Street guys? They're flipping smart. They would know this. I bet they would know this and they would adjust for it. They're very on the ball. I was so surprised at how good they are at accounting. Because people are always, especially you guys, some of you guys are the finance bros, right? Quite dismissive of accounting. But let me tell you, they know their accounting rules. They really do. Okay, someone had a question, Vijint. Yell at Vijint because I'm deaf. Getting old. I'll probably you could put it in either place. I would probably do something like, say, here's the opening shareholders equity section. And I have it set up like this. And I would say, what's the alternative presentation? And then I would say something like, these guys have a covenant. What should they do? And you're going to tell me they should use the other way, right? And then here are the other journal entries I want you to do. Like, just thinking about how I would set it up, because I'd want to force this to be visible somehow, right? That's how I'd try to get it in there. Okay. Yeah, you can try writing exam questions. Think like me. Try to write an exam question, and if you do, send it to me because I might use it in future years. I get tired of writing these questions. So really, if you want to practice, write one and please send it to me. I won't use it this year, though. I won't use it for your class. Okay, oregano. What a great question. Great question. Too long, but many good elements. So Radford, was it Radford that we just did? Yeah, it was Radford. That's a good length. This one, too long. So what I could do is do something like this and make it Radford length. Okay, so just a little bit less. I'm getting hot here. All right. So oregano was formed on July 1st, 24, authorized to issue an unlimited number of common and 100,000 cumulative and non-participating pref, carrying a $2 dividend. The company has a June 30th year end. You know, I would always like underline that or highlight it. If it's December 31st, your head thinks that way naturally about a 12-month year, but when it's off calendar, I would just note it to myself so that I don't forget. The following information relates to the shareholders' equity account, and they have common, pref, cash dividends, and retained earnings. And they just want us to prepare the 26-27 journal entries, okay? That's what I've actually done over here. Okay, common stock and related transactions for 26-27. But in order to do the 26-27 journal entries, I need to have a handle on where I'm starting from. So I'm going to set up my frame so I can track what's happening with the common shares. Just glancing at it, I don't need to do anything for pref shares because one thing happened. But for the common shares, I need to track what's going on. And so these first three transactions are before the fiscal year. So I'm going to do it the way we talked about before. I'm not going to write out the journal entries. I'm just going to put them directly in the frame. So before the 26-27 fiscal year, the company had 110,000 outstanding common issued as follows. 95 issued for cash at 31. Okay, so I'm just going to do this. July 1st, is that 27? Yeah. No, 24. Because it was back in 24 when this happened. Okay. Authorized, unlimited, and then issued 95. At 31. So then I have to multiply. 2,945,000. Okay, that's good. I'm done. 5,000 shares exchanged on July 24th, 24 for a plot of land that cost the seller 70 in 2014 and had an estimated fair value of 220 on July 24th. Okay, first, is that an issue or a buyback? What is it? Lily? It is an issue, right? They're receiving land. So the exchange is land for shares. I issued shares. Okay, Nathan, what price is relevant here? The 70 or the 220? Or Ally? It is the 220, right? Because it's who cares what you paid for it in 2014? That's on the seller's books. It's irrelevant to us. It's worth 220. So July 24th issue. 5,000 shares. 220. Okay. Keep going. 10,000 shares issued on March 1st. The shares had been subscribed for 42 on October 31st, 24. Do I need to do anything with subscriptions? Are these real shares? Nathan. Yeah, they're real shares. Like, this is in the past. They were subscribed. The people paid over time. As of March 1st, 2025, they did pay. We issued the shares. Like, the whole subscription thing is over and done. So this is just an issue. So we have 10,000 shares at 42. March 1st, 25, issue. 10,000 shares at 42, that's 420,000. Okay. I've done all the prior to the fiscal year transactions. I'm going to start doing journal entries for these, but now I'm caught up. So let's just get all our subtotals. Unlimited number authorized, 95, 100, 110,000 shares outstanding. Wait a minute. Okay, good. The company had 110,000 outstanding common shares. So these things are matching up. That's good. Everything's working. And the value, which they did not tell us, is 3,585,000. Okay, so that's where things stand just before we start the fiscal year. So now let's do the first journal entry. Subscriptions were received for 10,000 shares at 46. Okay, let's read on. Cash of 92 was received in full payment for 2,000 shares, and share certificates were issued. So you see how these subscriptions work? They issue as you pay, and then you pay more, they issue more. So those 2,000 are real shares. The remaining subscription for 8,000 is to be paid in full by September 30th, 2027, after the fiscal year end. So I've got 2,000 common shares and 8,000 common shares subscribed. So I'll do my journal entry first. Why don't you do the journal entry? Do the journal entry. I'm coming to look over your shoulder. Okay, okay. Okay, you might move it, okay. Okay, so I'm seeing people are getting the bones of it down, and most people are starting with, I know that the cash coming in is 92, which is great. And we issued shares for those. So let's just get the common shares down, and then we'll deal with that, the weird accounts. The weird accounts are common shares subscribed and subscriptions receivable. Which is the debit? Common shares subscribed or subscriptions receivable? Luca? It's not the debit.
That's it.
The debit is the receivable, right? Like we put receivables on the debit side, unless we're paying them off, but we're setting up a receivable. So it goes on the debit side. And then it does make sense because my common shares subscribed is on the credit side, like the common shares, like a faded out version of common shares. We just have to work out the amount, and it's 8,000 shares times they agreed to pay 46, right? 368. Everybody good? Okay, does anything need to be put into our frame up here? Okay, Luca.
We have 2,000 mark, choose.
Yep. So what was the date? October 1st, 26. It was an issue of 2,000. More shares, and the amount was 92. Okay, let's go to the next one. The company purchased 2,000 of its own common shares on the open market. Oh, they issued 2,000 and then 2 months later, they bought back. We've got a buyback here. Okay, so I'm going to be November 30th, 26 buyback. So I'm going to debit common shares. How am I going to figure out the amount? What's the amount? Lily? It is the average per share value, right? So it's a bit nasty because we need to get these two totals and then divide them. They set it up as we issue 2,000 and then we buy back to try and fool you into, oh, I issued at 46, I'm going to buy back at 46. Like I just put them on the books at 46. So that's the carrying value, but no, We don't do LIFO. Okay, we don't have a LIFO system for our common shares. We have a weighted average system. It is just like inventory, and it is weighted average. So we have to get the total number of shares outstanding, which happened to be 112,000 just before the buyback happened. And the total value of those 112 shares, carrying value, was 3,677,000. Now we have to divide them. It's not a pretty number. 3283. That is our average per share value just before the buyback. And so the buyback has to go at that value, which makes it 65,660. I promise you there will be a buyback on the exam. It's absolutely guaranteed, 100% chance. And you know what else? Very high chance, let's say 99, unless I screwed up. It won't be just one number. You're gonna have to take an average. So maybe because we started off with a balance at the beginning of the year and there was one issuance, but you will have to take an average. Because I want you to show me that you know that it's done on a weighted average basis. Don't just take, oh, we just issued, so I've got a book value. No, you won't. Like I say, unless I messed up, but pretty focused back in January. I'm thinking, oh, this is going to be good. Oh, let me do this. So I'm sure I did it right. I'm like 99% sure. So don't. Redemption, more work. Got to get the average price. Like, think that. Credit. I had to pay cash to buy them back. Can't remember how much cash I had to pay. $39 per share. Oh, look at that. Restored to the status of authorized but unissued. So these ones were not canceled. So I'm not going to take them out. I mean, it's unlimited, so it's kind of irrelevant, but I don't have the 2,000 here for this one. So cash, 2,000 shares times 39 per share, 78. I'm short a debit. What am I going to debit? Vigent? Retained earnings. Yep, this is a loss, and we never touch gains or losses. We don't have any contributed surplus. I've seen nothing about contributed surplus. We have none. So we take it through retained earnings. If we did have contributed surplus, then we'd soak up all the contributed surplus, and any excess we'd take out of retained earnings. With contributed surplus, you never go below zero, right? You either have contributed surplus or you don't, but you don't have negative contributed surplus. That's when you go to retained earnings. And honestly, you can have negative retained earnings. Not a great look on your financial statements, but it is possible. In fact, since we're here talking about buybacks, are share buybacks a good signal from a company? Is it good or bad if they're buying their own shares back? Do you know any companies that buy back? Garage? it's a good signal. They have money and they're bidding up their own share price, right? Because now they're in the market competing to buy their own shares. It's a good sign. But the more they have to pay to buy back their shares, you see what happens? The more debits to retained earnings. So, you know what companies, I don't know if they still do, I haven't looked at their financial statements in years, but you know, there's some big companies that you know that either do have or have had negative retained earnings, which you would normally think, what? They're so profitable. Buybacks. Their share price has gone so much higher than when the shares were initially issued that when they do buybacks with all their gobs and gobs of excess cash, their retained earnings account goes into a negative. What company might that be? Apple. A lot of buybacks. I'm sure some of those other big tech companies have done buybacks and they end up with negative retained earnings. And you're thinking that's not good, but it's actually really good when all the buybacks happen because your share price got so high, but you still had so much excess cash you didn't know what to do with it. So you did buybacks. Okay, let's keep going. What happened on December 15th? So we did this one December 15th. The company declared a 5% stock dividend. At the fair value for shareholders of record on January 15th, 2027, to be issued on January 31st, the company's common shares were selling at 52 on December 15th. A 5% stock, 5% of what? 5% of what for this? What does that mean, a 5% stock dividend? 5% of what? Yes, Nathan?
Stock price?
It's not. It's not the stock price. Emily?
The shares outstanding.
Yes. 5% of the total shares outstanding. You know, it's tricky. When you're in the middle of the exam, that's when you're saying, wait a minute. Okay, 5% stock dividend. I got it. But 5% of what? And I see lots of different tries for different things. One of them is 5% of share value. So, oh, we didn't post. Did we post the buyback? We did. Okay, good. Now we need to know the number of shares outstanding at that moment, December 15th. It's not actually, they're not issued until January 31, right? But I need to know what the number of shares outstanding is, so I need to get a subtotal again. Now, I'm not desperate for this subtotal because it's just the number of shares. So it's 110,000 times 5%. So we're going to issue 5,500 shares. And we, like any issuance, we always do it at the current market price. Which they told us was 52. $286. Okay, what are the accounts we use for stock dividends? There's many accounts you can use for stock dividends. On the Wiley Plus assignment, they are super rigid about the account names they want you to use. You know, hopefully I'm going to get a few moments to go back and adjust everyone's mark, because if you put something logical, even if it wasn't what they wanted, I'm fine with that. And on the midterm, I'm fine. What account could you use? Just give me an example and I'll tell you if you'd get a mark on the midterm. Okay, try me. What did you try when you were doing the Wiley Plus assignment and it kept telling you you were wrong? What did you try? Natalia? Pardon? I'm coming over to hear it because you're not yelling at me. Retained, yes. That's the one that I would choose. Retained earnings. What else could you say? Stock dividends, dividends declared. I'm good with all of that. Any of those. Dividends, stock dividends, yeah, fine. Like, to me, you get it. I don't need more than to know that you got it. And then I issue common shares. Now, I did issue common shares, so let me put it in. I issued 5,500. They were eventually issued on I thought it was January 31st. It is. Why do I have January 15th? It's January 31st. Sorry, it's common shares distributable at first. And then when we actually issue them, just goes to common shares. On the exam, I would say they declared and issued them on the same day because I don't want to waste marks on this. It'll just be a 2 marker and kind of one and done. Okay. 286. And then the last thing, the company sold 500,000 of its own common shares for 21,000. Why don't you do the journal entry for that one? Because that's not too bad, right?
What the fuck?
The issuances, those are the easy ones. Issuance, easy. Redemption, buyback, less easy, but still doable. So you should have debited cash for 21,000. $500 shares at, oh, I don't know what the individual price is, just 500 shares for 21. And then I would complete my table so I know where I am by year end. Okay. By the end of the year, I had an unlimited number outstanding, 116,000. Issued an outstanding and 3,918,340. Honestly, I can see doing this kind of thing on an exam. It's a lot, it's dense. But it gets to be too much with all this and with the preamble stuff. More likely, I would just tell you what I wouldn't give you the table, but I'd tell you this. about the common shares as a starting point. So if you didn't have to do these 3 transactions, I think you could do all of that. But you can see that it's a little bit tricky. You need to get the subtotals at various points in time. So you need a good system for tracking it. So this kind of a table helps you track it. Okay, preferred shares. That happened like forever ago, so there's no transactions this year. Cash dividends, let's read about this. The company has followed a schedule of declaring cash dividends each year in December and June, and making the payment to shareholders of record in the following month. The cash dividend declarations have been as follows since the company's first year end up until June 30th, 2027. Which is our fiscal year end. So they declared cash dividends on December 15th for common and pref. And then a month later, they would have paid them. Then on June 6th of 2026, they would have declared cash dividends. In July, they would have paid them. On December 15th, 2026, they declared cash dividends only on the pref. And remember, they declared a stock dividend on the common
but it's gonna
that
be
year.
like a surprise pop-up in cities free tour. But we're starting in Toronto because that's home. So
Let me-
day after tomorrow, and I'll have the location and stuff very soon. But yeah, day after tomorrow, Toronto.
Let me see if I can mute this person. Who might not realize that they're telling us about their business, or, you know, maybe they do realize.
I'm not gonna tell you guys. So
Carl Contoy.
Oh,
You need-
sorry, my bad, sorry.
Okay. Now we're good. Okay. Which of these things, like, the tricky thing here is what falls in the fiscal year? Which of these things is going to fall in the fiscal year or has something tied to it that falls within our fiscal year? Our fiscal year is July 1st, 2026 to June 30th, 2027. Which of these things falls in our fiscal year? Luca?
One. One.
Right. So there's going to be, we need 3 to 4, depending on whether we do our common and pref separately. We might have 2 entries here to pay, 1 here to declare, and like a month later to pay. I like that question. You know, it's not handed to you on a silver platter. You have to just put in that little bit of extra work. I like that. I think it's clever. I like it. You might see something like that. I don't know. I'm just saying that. Clever. Clever way of delivering the information without making it so obvious. So how did I do it here? Oh, I combined them into one here. So it said a month later they pay, so I'm just assuming that it's going to be on July 6th. So if they pay, what's our debit account? If they're paying the dividend, they've already declared it. What's our debit account? Our credit is cash, right? We're paying it. What's the debit? Vigent? Dividends? Lily? Dividends payable, right? Because we've already declared last year. We don't want to declare this year, right? Because it didn't happen. So we're just clearing our dividends payable. Pref and common. But look at that. They didn't tell us the amount. We have to figure that out. How many pref shares were outstanding on July 6, 2026? How many? It's 50, right? Because nothing changed since 2020. So it's 50. How many common? Very good. Everybody good? How many common shares? We have to go here and read our own table. How many common shares were outstanding on June 6th when these dividends were declared? I don't think, did I ask you your name? No. Okay, tell me. Good. It's 110, right? Because between March 1st, 2025 and October 1st, 2026, we were steady, which means that it was 110 at the point that those dividends were declared. Love this question. I think it's $6. No, did I say 6? Oh my goodness. For the pref, it was 3. No, it was 1. It was 1. And for the common, it was 30 cents. So it is 50,000 and 33,000. And then our cash is just the 83. December 15th, we declare. How many shares were outstanding for the dividend declaration? How many shares were outstanding? We're looking at December 15th. How many shares? You're going to have to tell me your name. Aiden. Okay, Aiden. It is. Good. You got to read. We're talking about the pref shares. They're the ones that got the dividend. Then you look back to pref. Oh, nothing has happened. It's still 50. Good. What are my accounts for a dividend declaration? What will I debit and credit? Luca?
Dividends, payable, that's the.
Debit,
Dividends, for dividends declared for a share and then credited into the vote.
yes. I'm just going to put dividends and dividends payable. And then when we clear them a month later, we're going to clear out the payable and pay the cash, right? Now, this entry here, I will never ask you. I'm just doing it because part of the question. As at June 30th, the company's retained earnings account had a balance of $690. For the fiscal year ended, they reported net income of 40. I mean, so they want us to do a closing journal entry, which I will never ask you to do, where we're going to close out of income summary into retained earnings. It's just not that useful. So I will never ask you to do this. Okay, last question. Which of the following is not a right of shareholders? What is it that shareholders don't have a right to? A, B, C, or D? Mitchell. Yes, it's B. It's too cumbersome. They can't be involved in management decisions. It's okay on the board of directors if they set strategy, but they can't be involved in every management decision. They do share proportionately in profits and losses. They do share proportionately in assets on liquidation. So if there's any money left, let's say you're winding up a corporation, pay off the creditors, pay off the pref shareholders. If you're just winding it up, you know, because you want to retire or something, there could be money left, and the money left gets shared on an equal basis across all the shares. That's proportional. The right to share proportionately in any new issues of shares of the same class. I don't know if you guys have ever heard about this, but it's called a rights issue. When a company is not doing an IPO, it's not its first issuance to the public, initial public offering. Any ones thereafter are called rights offerings, because first you offer to your existing shareholders the right to buy the number of shares that would keep their percentage ownership the same. And if they decide not to exercise their rights, then those shares can get issued like an IPO into the market, and people in the world can buy them. So yeah, they always have the right for new shares. First have to offer it to existing shareholders. 2:12. 8 minutes early. That's good. Time to get ready for the weekend. There's going to be nothing but this on the exam a week Tuesday. None of the stuff we do next week, but we still do need to do the stuff next week. Okay, now, when do you want to have I guess we shouldn't have a class about the group project. I'll probably do that like on a Friday or a Monday or a Wednesday. But you guys can let me know when you want to talk about how to do the group project, okay? So, yeah, I'll wait till people start asking me, and then I'll think of setting it up. Okay, have a good weekend. And you guys online too.
We were reporting the subscription share for this one. Why don't we also have a common for subscribe too?
But you do.
But before like this and this question. Then why don't we do common shares like this?
Okay, because for this one, they this year payment for 2,000 shares was received and share certificates were issued. So the way they do their subscription is every dollar pays for a share before it starts paying for the next share. You know what I mean?
Okay.
Whereas in the other question in Radford, every dollar pays for a little bit of every share. So you haven't bought one share yet. Okay? The shares will be issued upon collection of the subscription price in full. So nothing is issued until all the money is collected.
Oh, I see.
Okay. So it's like you're 30%, you're putting 30% down on every share you subscribe to, but you have not bought one share yet. In the other one, you buy 100% of one share and 100% of the next share.
Mm-hmm.
You know, see how it's important to look at how they're describing the subscription deal.
Okay, I see. So at what point would we convert all the common shares subscribed into the normal common shares?
Well, we did have that. It happened in this question on the 42, right? So this is the third one on March 1st. 10,000 shares were issued on March 1st. The shares had been subscribed to for $40 on October 31st. So on October 31st, we would have set up common shares subscribed.
Mhm.
And then on March 1st, we would have debited common shares subscribed and credited common shares to just move them into common shares. But we didn't do the journal entries because that was all in the past.
Oh, I see. Okay,
Okay,
that makes more sense now.
so
Thank
it's
you.
all making sense now?
Yes,
Okay, good.
thank you.
All right, see you, Matthew. Yes, Marcus. Oh, yeah.
Perfect. I just want to confirm, so the midterm's on the 7th, but so we come to class first to do the multiple choice at class time?
Yeah,
And then, yeah, so midterm's at 5:30.
yeah,
Okay.
in McLaughlin.
Okay. And you just said it, but it's only the chapters 13, 14, 15, the first 3 weeks.
Yeah.
Okay.
That's it.
Is the group contract like worth most?
No, but I'm gonna chase
Yeah,
you.
yeah, no, I'm gonna get it, but it just comes again, so like.
Because when I have a group problem later,
Mhm.
I can go back to the contract and say, well. You know, and that's how I can hit people for not. Because if I don't have it, I'm kind of.
Yeah, no, because I was just wondering, like, again, if I emailed like the one guy again, but if I can't get a hold of him, should I just submit it with my name signed, or should I maybe wait a couple days until maybe he responds, get his name on it, then submit it?
If his name is on it and he didn't sign it, that
Then-
becomes his problem.
Okay,
No,
yeah,
you can see it, like he
Yeah.
can see the Dropbox.
yeah, okay,
And the contract was there, so why wasn't it signed?
yeah,
That's his problem too.
okay.
And you know, that's what got assigned to him.
Mhm.
So he,
Okay,
it's just, it's all to help me hold people
Yeah, yeah.
accountable.
okay, sounds good.
Okay,
All right, thank you.
Hello.
hello.
I'm not sure if you remember, we spoke over the summer about GDIP stuff. You know that I've been
Yes,
doing all my co-op terms at EY, and like you remembered Cassandra Reed and Malcolm Rice, who are actually my colleagues at EY. We've worked together for years now. I wanted to just bring up.
Can you tell me your name again?
I'm Elliot. Elliot.
Oh, yeah, Elliot. Yeah, okay, got it. Yeah.
So my major is management economics and finance. But
So you're a finance bro.
I'm leaning towards accounting these days.
Okay.
Done all my co-ops in accounting, obviously. And I'm looking at applying to the GDIP for next summer. And so I've been looking at the application. I think overall it's looking pretty good, except that I need 3 academic references for these 2. And I'm wondering whether or not you might be willing to do that for me. I know we don't know each other very well.
What's your average across the core CPA courses?
Across core CPA courses, I'm not sure exactly. I know my cumulative average is like 82, 83 right now. I can find my average for CPA course.
If your core average is gonna be in the 80s.
Yeah.
You're right. But you know what? You're not in like audit 2, are you?
I'm not, no. I
Okay,
was
so
hoping to take that, but I
you might not have time.
not space for it, so.
Yeah, so, you're not hearing what they're hearing, which is,
Exactly.
you gotta get it in soon.
That's my plan. Yeah, one
Yeah.
of my friends in that class and he was like, you gotta get on it. So I'm like, okay.
Yeah.
And it's through OUAC, which is through my old high school email address that I don't have access to anymore. So I need to call that this afternoon. But,
I mean, why can't you use one of your former profs?
former prof.
Yeah,
I
just,
could,
just
yeah.
anyone.
I think in general, my learning
You're in
style,
the
I don't
80s.
talk to the professors that much.
It doesn't, you know, most of them won't worry about it.
Yeah,
Like,
okay.
usually if someone's been in my class, I'll just give them a rep,
Yeah.
because I know them.
Yeah.
But, if you haven't been in my class, it's hard for me to assess stuff.
No, I understand, it's difficult.
You know, but if
yeah.
you, I don't have like a comparison group for you.
Yeah, no, for
You
sure.
know, so if you're desperate, yeah, but I'm sure your former instructors would.
Yeah, I was gonna
They,
talk to
they
Connie,
understand.
cause I have taken audit 1 with her, but yeah, no, I totally understand.
Take an audit 1 with her, get her to do it. That's
Yeah.
1.
No.
She'll do it. I'm telling you right now, she'll do it.
And so just.
So you just need 2.
I can't use like the false wise or something like that to show like industry experience. It has to be like professor.
No, you can.
I can't.
Get,
Okay.
ask Malcolm.
Okay. Perfect.
ask
That's news to
Malcolm.
me. When I was like, my friend was talking, Connie said it's supposed to be professor, but
It's
Okay.
supposed to be, but so what? I mean,
Yeah.
you've got the core average.
yeah. Okay.
We're not, you know, not gonna worry too much about the refs because Connie knows you
Yes.
and it's kind of done.
All right, thank you so much.
Okay.
That's good to know. Thank
All
you.
right, see ya.